we could talk about all day. All right, guys, we're here with George. A hurricane of bearish market action. How do you guys like that headline? That sounds really, really scary. So I mean, everybody probably looked at the market the last couple days, and they're probably all in fear. I get emails, and I'm sure you do as well, from clients, which are like, "Oh my God, oil went down 5%," and you're like, "Well, oil went up, 20% in the last couple of weeks." Like you could have these conversations back and forth forever. But what makes people in fear of markets is kind of the thing I always kind of think of. What makes people so afraid to really hang on to these trends? And so that's a question I want to pass to George is, if you're hanging on to these trends and how do you buy something, sit in it when you have little pullbacks, or not even to most people, they're huge pullbacks. To me and you, they're little pullbacks because we position size. But for them, it's huge pullbacks. So how do you hang on to trades, put on the trades, and just sit in them and let them move like a good trend follower would?
Yeah, it's hard. I mean, nobody wants to give back profits, right? I think there's no right answer. I think it depends, again, on clarifying what you're trying to capture, and then just accepting that you can't have it all. Yeah, that's something I think a lot about, right? So, like the vol targeting debate amongst trend followers, essentially it's like you buy a position and it goes way up right away, and your stop is back down here because it hasn't moved along with it, right? And so there's like the Jerry Parker camp who says, hey, that thing could keep going and going and going, and like if I adjust my stop, then I might lock in some gains, but I could miss a 10 bagger or whatever, right? And then the other side, which is, I guess, Tom Basso and others, I think the majority of them are vol targeters, they say, I can't afford to give that much back, so I'm going to adjust, my stop one way or another based on the volatility and the open trade risk. And yeah, I think the biggest thing is like you have to sort of say, this is what I'm trying to capture, and I can't have it every which way. And, if I vol target, well, I guess there's only so many outcomes, right? If you don't vol target, don't adjust your stop, and it goes up tenfold, it checks back and then goes up tenfold, you say, well, see, that works, right? And then if it comes all the way back and you give all the open trade equity profits back, you're like, damn it, right? And conversely, like it could work. I guess I'm not walking through every instance, but you understand what I mean. Like there's pros and cons depending on what the markets do. And sometimes with the benefit of hindsight, you'll say, oh, geez, I shouldn't have adjusted the stop because I would have made tenfold. And other times you say, oh, I'm glad I adjusted the stop because I didn't give everything back. And really, unless you have a time machine, you just have to accept like that's the way it goes. Sometimes it's going to work in your favor. Sometimes it's not. And you hope that over the long haul, you're going to be able to, get basically enough good outcomes from the one you decide on to make it work. So I think we might have lost Jason. Hold on one sec. If anybody has any questions, I'm going to see if you can come back, but feel free to post questions or comments and I can answer them.
All right.
Oh, you're back. Okay.
Yeah. Sorry, guys. The storm has decided to be a major asshole. But no, I mean, I think that when you look at trades, this is the hardest thing to do, I think, as a trader. And it's the thing that changed everything for me, which is like really understanding what I'm doing before I take the trade. Like, that I think most people, and this is probably just so at this point, it's probably just a thing you don't even think of. I don't even think of anymore. But for new traders, it's something that they don't do. They think that they're going to get some magical piece of news, or, I'll have conversations with people who are in markets or just getting into markets, and they'll have all these ideas, and their ideas go like, okay, well, this stock fell a lot, or I'm going to buy this one that's lower and this one's higher. I'm going to sell my winners and buy my losers. Like, all of these things are ridiculous. What you want to do as a trader is understand, like, you're going to enter this position. I'm looking at a chart of cotton right now. I know not everybody on here is probably trading cotton, but let's say cotton. You take a trade in cotton. And before we put on the trade, I know, like, okay, I'm going to enter on this signal. I know where my trailing stop's going to be at before I put on the trade. I know that the exit signal is going to be a 50-day low, a 60-day low, whatever it is. So I'm going to be able to hang on to that trade. I'm going to know when I'm going to get out before I'm getting in. And George knows this because I know it's in your books as well, George, where they talk about, you always talk about getting out, knowing where you're going to get out before you get in. That is probably the most important piece of information in your trading principles books, which I see over and over again. You see it in every market wizard. You see it in every single good trader. What they all talk about is that. And I think the reason is it's psychological. It's once you're in the trade, like you said, the first thing you said, nobody likes to give back profits. That is the truth. So if nobody likes to give back profits, and we're in a trade and we're making money, trust me, I see tons of trades in my account all the time, and I'm like, great, they're making money, but the trailing stop is not in a profit at all yet. I would love to move those all up in my brain, but if you back test and you understand how these things work, you know that's going to make you lose money, so you don't do it as a trader. So knowing where you're going to get out before you get in is probably the most important thing that we do as traders. And I think that's got to be like the first thing you do, so you don't panic about little pullbacks or things that are out of your control. Either way, it's out of control. Whether it's a little pullback turning into a big one, or a medium pullback, whatever it is, or a full-on bear market, you can't control that. So what you can control is entering the trade, figuring it out before you get in.
Yeah, I think that's right. I mean, and I think we did it a week or two ago, but we looked at the 5-day high low and the 100-day, and I don't know. Everybody says don't trade very fast, and because you just get chopped up, and I think that's right in my experience. But then you have to decide what kind of move you're trying to capture. If you want to catch a 10-fold move, like, you're gonna have to endure some volatility. It's an interesting point. I did like a study of Louis Bacon and published it here. I can post it to you. Once again, I've not gotten the account to do that thing, but it was fairly popular because there's not much out there on him. Whoops. Hold on one sec. Anyway, so, he had supposedly, I've never seen his actual returns, but he had very modest drawdowns and didn't have any terrible months. And by virtue of that, you can kind of infer how much leverage he was using and what kind of moves he was trying to capture. And he said, or people that knew him said, he was in and out. Like, if a move was going from 50 to 100, he might be out 25 times in between. He wouldn't just hold for that whole move. And the reason becomes why. And I mean, I think my perception of it, based on everything I've studied, is he was trying to catch the stable up moves and didn't want to sit through the big ups and downs. And that way he could manage his losses and his volatility and his drawdowns a lot better, right? But so, and by virtue of what I've read about his drawdowns and his returns, it's like he probably wasn't 10 to 1 leverage, because a 2% move would be a 20% drawdown. And like, if you think about how returns are measured month by month, it's like if you went up 10% this month and then you're 10 to 1, it's 100% return, let's say, and then you go 2% next month, it's 20% down, even though you're only giving back 2 of your 10, right? It looks like a 20% drawdown looking at monthly returns. So the fact that he didn't have that means he either was very, very good at getting out quickly, or he didn't use that much leverage. The other interpretation is that he was basically playing for probably stable moves, and as soon as it got rocky, he'd get out and say, okay, well, I'm going to try to just capture these nice little moves, whatever he specifically was focused on trying to capture. But I think that just gets back to the point of like clarity on what you're trying to do. What are you trying to accomplish? What can you take in terms of drawdowns? What kind of returns can you get? And knowledge that you can't have it every which way, right? So we'd all love to be, 10-to-1 leverage on something that goes up 100% because we make gigantic returns. But odds are that market's not just going to go in a straight line. So you're going to have to endure some significant 30-40% drawdowns, because if you're 10-to-1, a 3-4% pullback is going to do that. You'll probably wipe out realistically. But anyway, I guess just clarifying all of that. Are you trying to capture short-term steady moves? Are you trying to capture long-term moves? What kind of leverage do you use, if you use any leverage? And then what does that equate to in drawdowns? And if you look at enough of these return profiles and you play with these variables enough, you can kind of start to get a sense of, okay, this guy must have been doing this and he was doing that. And, then like the Michael Marcuses of the world, somebody told me that he had 80% drawdowns and he wiped out early in his career too, right? So he was obviously very leveraged. He once called a 2% move in currencies like a move that it started at 2%. He's like, a massive move. And like 2% is big in a currency, but I don't know that anybody would call it massive. And then he's like, the subsequent move would have been total annihilation. And it was like a 10% move. So if you're unleveraged, I don't think you would call a 10% move annihilation, right? You'd probably say, it's annoying. But if you're 5 or 10-to-1, then that's game over. So anyway, through all this stuff, I think you could figure out what you're trying to capture, how much leverage you can use, look at charts, look at markets, just big moves, NVIDIA, Cocoa, whatever, like they all retrace a bit. And if you have too much leverage, you're going to wipe out. And if, you find the right amount that produces a drawdown that you can take, and even if it's a realized give back, if you're managing money for yourself, that's one thing. If you're doing it for clients, it's another. So let's say that you buy Cocoa and you make 500%, right? I mean, if you have a 50% drawdown, then you'd be like, well, that's nothing compared to the entry of the trade. But it's still, I think clients would run for the hills, right? And you probably wouldn't be able to take it. Most people can't handle 50% drawdown. So I'll stop the ramble there. But basically, I think the point is you have to look at all these things, define your goals, see how it works, study the market, study other traders, and you come up with this sense of, here's where I need to live and be to achieve the goals that work for me.
Yeah, no, that's well said. And when you think about, I think the thing that's interesting, and I see a lot of people clicking on us today. So just, so you guys know, hurricane of bearish market action. We're here trying to tell you guys the actual truth of trading. I know this isn't going to get as many clicks or likes as other things, but this is how you actually trade. This is two managers having conversations about markets and how to trade. So, make sure to subscribe to George, make sure to subscribe to me, and you guys can make sure you don't miss any more of our updates. But if you're looking for like trading in general, I think what you said is perfect, where you're thinking about like the volatility of the product. And then you have to think about the leverage of myself for the volatility of the product. And so like this could continue. And this is where these conversations get off to a lot of like new traders, because they're like, man, why are these guys talking about this? This is boring as hell. At the same time, it is everything. Like things I think about and conversations I have with high level traders when we're off mic, especially. We talk about this. We talk about position sizing. We talk about correlation. I probably talk about correlation more than anything on earth, because it's the thing that I have to figure out every single day. Because I have to think about, am I too correlated in one area? And also, then am I overly uncorrelated? That also happens. I think the idea of some of the trend guys where they get into okay, well, I have to be extremely uncorrelated to make money, and then they have massive underperformance, is because they're extremely uncorrelated. Now, granted, that doesn't mean it's all bad. I'm saying, if you have a diversified portfolio, you have some money in a buy and hold, you have some money here, some money there, fine, whatever you want to do. But if you're looking at it in a way like I'm a trader for myself, or I'm trading for a small fund or something, and you're trying to just have good performance year after year, you have to also think about how uncorrelated you are, and you don't want to be too uncorrelated. But I'm just saying, these are all the questions you guys should be asking yourself. What size is each position that I enter? Size to my stop. If you're using options, I'm not speaking to you at the moment. If you're using futures, if you're using ETFs, stocks, whatever, what's the position size to my stop? Am I losing $100, $1,000, $10,000? What do I lose per stop? Okay, then I have to figure out how to size to my stop. Am I a short-term trader, whereas, a 2% stop is far enough? Or am I a long-term trader like myself, where a 20% stop might be long enough? You have to ask yourself all these questions. And I know they are boring as hell at first, but this is how you make money. And I promise, if you continue to go that route and you continue to like answer those questions, and you know where you're getting out before you get in, you'll make money over time. Too many traders are on here thinking that it's a thing about being right. Like, we just get on here, we'd be right. Yes, if you want to go to the Twitter and scroll through and find all these furus talking about all types of crazy stuff, how they bought this one thing and it made them all the money in the world, fine. That's all bullshit, but fine, you can do that. But if you want to learn how to actually do this, it's a consistent mix of all of your different positions. If you have a position, if I have cotton and I have, let's say I have cotton on, I don't at the moment, but let's say I have cotton on, I have oil on. I don't have these at the moment, but I'm explaining something. I have cotton, lumber, let's say the S&P 500, the energy sector futures, a couple other things that are kind of reflationary. That's kind of all one trade. Let's say I'm also shorting bonds. That's all one trade, basically, but I'm diversified in some form of way that makes a little bit more sense. So you want to think of trading as my portfolio has to do well. I don't give a shit when somebody tells me, oh, they bought this one thing and it did well. I could give a shit less. I'll be honest. Like, it doesn't mean anything to me. It doesn't make me go, man, that's awesome. It makes me go, well, what does their portfolio look like? Because it means that if you're trading super large, it means that your one trade, when it does well, but that one trade also wipes you out when it does badly. So understanding the whole portfolio as a whole, the volatility of that whole portfolio, your position size per position, catastrophic stop loss is what I call it, when everything gets stopped, your size of your whole portfolio getting stopped out of each trade at the same time. You understand all those things, you make money in the markets pretty easily.
Yeah, as you're talking, I was just thinking I think most people want easy answers, and the easy answer is buy this stock today, and in 6 months it'll be here. And one of the things that you pick up, and you mentioned this a little bit ago, but with the market wizards or great traders, whatever, is they really don't know what's going to happen. And they readily admit that. They say prediction isn't part of it. Yeah, most of it's just saying, okay, when things go poorly, I'll get out, and things that work, I'll stick with. And I think a lot about Soros, and his motto or whatever was invest first, investigate later. And the point was, he would take a toe hold position, which is a small position, and then if it worked, he would add to it, which is what Livermore did. And if you study what those guys said over the years, they're very similar, which I imagine Soros studied Livermore, because I think Livermore was dead by the time Soros became prominent. But anyway, it's about cutting your losses and survival. That's really the key to the really great traders of all time. And they sometimes, some of them know that they have to talk about ideas to get attention on TV, but really what they're doing behind the scenes is focusing on these principles that lead to success. And so I think it's important. Like, if you think that somebody on TV or wherever stream is going to tell you this is a stock and it's going to go here, they probably are throwing a lot of spaghetti, and maybe they'll get one of them right, but they're going to get a lot wrong. And it's just, I think the path to profitability is to have a deep understanding of the principles, the theory. And then from there, you can sort of adopt your own method within that structure where you're not violating specific rules. And you can decide, well, back to Bacon, like, he wanted to not have huge drawdowns, but he wanted to make a lot of money, right? So here's how he did it. And Michael Marcus's goal was, in theory, to make he said he wanted to be the best futures trader ever. He didn't define that, but it probably meant make as much money as possible. And he took massive drawdowns, right?
Yeah.
Another thing, I guess, is this being right. Scott Bessent was talking about Soros in Drobny's book, and he said that Soros was wrong 60 or 70% of the time, but when he won, it was so big that it offset all those losses. And I think this like frequency versus magnitude thing is so important to understand. So in Western culture, and I've probably said this before on here, but it's like if a football team has 10 games in a season and they lose 9 games by 1 point and win the 10th game by 100, like they're losers, they're terrible. They have to win more games. The points don't matter. But with money, if you lose $1 9 times and you make 100 once, you're net up $91, assuming no commissions, whatever. And what I see, you see people say, well, reporters say this a lot. It's like, as long as you're right more than 50% of the time, that's the edge that it takes to become successful. And I don't know if I cringe, but every time I read that, I'm just like, oh, that's sort of off base, right? Really, you don't have to be right more often than you're wrong. As long as your winners are bigger than your losses, then you can net be profitable. Back to that lose 1 9 times, make 100 once, or whatever the number may be, right? Anything greater than 9 would be profitable. So, and I think these are the things, like it's not sexy, it's not exciting, it's not bear porn. It's what functionally works, what's worked across different traders, and I think of it as like a structural frame of like a stock car, right? And then what goes on top and the stickers, that's all different, right? So people come up with their different methods, but the great people, they have the same 3 things in common. Really, I studied them and I said, okay, here are the people that have been some of the greatest of the past 100 years, and here are the variables they talk about. And went through and it was like, wow, diversification, like Ray Dalio says it's a holy grail and Drunken Miller says it's stupid, and they've both been very successful. So does it matter? And the only 3 things that really rose to the top were like respect the price action of the market, ride your winners, and cut your losses. And I think that's the structural framework you have to start with. And again, all this stuff is not as exciting as saying this is the stock and NVIDIA and they make AI chips and they're great, or bear stuff's even better, right? Like the debt levels.
We're all gonna die.
States, and doesn't matter who wins, and unrealized gains are going to be taxed, and they're just going to keep taxing, and you're going to have to sell your house tomorrow because you won't be able to pay the taxes on your unrealized gains on your house. That stuff gets attention, but yeah, I guess years ago I would sort of trade on that type of stuff, and it didn't work out well, like over and over. And I guess I'm kind of an idiot because it took me a while, like beating my head against the wall or sticking the fork in the light socket to realize. But for whatever it's worth, I guess you labeled this something that's like clickbaitish, but the truth is, if you study the theory and the principles and the things that have led to success, even if you want to take the bearish slant or focus on a specific stock, they'll protect you from sort of devastation if you're wrong, which most people are. I think that at least most of the great guys that I study, they're not right more than 50% of the time. They're wrong more than 50% of the time. They're probably wrong 60 to 80. And one thing I've kind of had a theory on is the more you're willing to lose in terms of frequency, a lot of times, those are the guys who make the most money because they'll get out right away, like very quickly. If it ticks against them, they're out. So it's very tiny losses. Yeah, and then the one, they just go all in on it and it goes up and they sit on it, subject to how they're trying to capture the trends and the moves. They make a lot of money. So yeah, and it's like the thin ice. If you can skate on that thin ice, I think you can get good results because most people can't accept it for one reason or another. So
no, that's perfect. And I mean, when we're looking at all these things and we're talking about all these things, and even like the idea is that cut your losses quickly, let your winners run, but figuring out how that works, like understanding like you're not gonna catch a 200% move in cocoa if you have a 2% stop loss. You're gonna get stopped out every single day, basically. Like you're never gonna make money on that trade. You're gonna get the death by 1,000 cuts. But understanding, an interesting thing, George, on Dalio's correlation idea, which is he wasn't exactly saying uncorrelated is the best. He is saying that there's a level of, and this is the thing that I constantly am working on, and I think I found most of it, but I think it's going to be one of those lifetime processes where I'm always working on it. But if you take, if you buy like we're talking about. You buy a couple things that almost work together. You know, you're long oil, you're short, you know, the 30-year bond, because that usually goes down in inflation. Let's say you're long, you know, something like copper, which usually works in an inflationary environment. You're long a sector like energy, maybe financials. If you have that type of diversification, it's good. What I find when I start to get this thing where you start to go, okay, well, I need to, if I'm long energy, I need to then short financials. I need to do all these things differently. That gets to a point where then you're entirely too uncorrelated.
I guess was that a question? Sorry, I'm not sure.
No, I cut off because my dog started going nuts, but
Okay. You know, I think like the trend guys I respect, they're big time into diversification, and I'm personally not as much. And I also think that if you do a leveraged trend system like high leverage,
well, hold on, George. Let's before we go, let's say what exactly we're talking about, because some people think when we're saying like for example, if we're talking, Warren Buffett says, you know, on correlation is stupid, you know, don't do thing, you don't want to be too uncorrelated or across all these different things. But at the same time, he has a, you know, if a normal person looked at his portfolio, they'd say, wow, there's a lot of diversification in that portfolio. So what do you mean by, because what I'm trying to say, I'll identify what I'm saying. I think trend followers buy too many things. Like when they start to get over 100, 200 different tickers, and they're trying to trade all these different assets across, and they're almost the same. Like you're in copper in the United States, you're in copper overseas, you're in copper. Sometimes you're overly diversified when you do that, and it starts to really eat into your returns. And when I backtest that, it absolutely does. So I'm more talking about taking signals in 50 tickers. Position wise, you're probably in 20 positions at a time, somewhere around there. That makes sense to me. When it starts to get to that point, like a lot of the trend followers do, where they're in like, you know, 100 different positions at a time, looking for more and more diversification, like someone like Jerry. And you know this, Jerry will talk about it all the time. Oh, I want more assets. You know, like he would trade, if there was more things to trade, he would be trading probably everything possible. I mean, he's trading individual stocks even. I'm not hating on it. That's the way he does his thing. But so what do you mean by, you know, if you're looking at your portfolio, you know, how many positions do you think is a good idea for traders to use? What do you think about those things?
it's such a can of worms. There's no way I'm going to be able to answer that robustly in 8 minutes, so we could attack it next week. But I guess what I've seen is that the guys who make the most money historically sometimes lose the most money, take very concentrated positions, whether that's a handful of stocks, you know, so like Michael Burry and Buffett and Chase Coleman from Tiger Global. If you look at their 13 Fs in stocks, I mean, the vast majority of their portfolio is in 4 or 5 stocks, very concentrated, you know. They have big ups and big downs. But I think if you want to make big money, you have to be concentrated. Now, that said, then you look at like Richard Dennis, and he was super diversified. He made big money, so he stacked a bunch of leverage on top of his diversified trend system. And so I tend to view that as like one bet. And I'll kind of just touch on them briefly, and we could tackle it more next week. But correlations to me are problematic because they change, right? And so it's like, what look back window do you want to use statistically to determine correlations going forward? Do you optimize it by doing various walk forwards? You use 100 days, 200, 300? What if you get different answers across the different horizons? How do you decide, like, well, this is the right one and this is the wrong one? I have issues with that personally because I've had bad experiences with it. I also find that, you know, there's fundamental realities. I mean, the stock market's probably the best example, but it's like, say that there's 2 companies that do the same thing, and then one of them spins off a business, and so they're not the same companies anymore. But if you're just looking at the data, and this is probably a rare case, but you're not going to know. If you're just looking at the historical price returns and correlations, and you're not focused on what those companies do, you're going to be like, well, they're correlated, I shouldn't, you know, but then like they're fundamentally different businesses now. So how do you, it creates problems, I guess, once you look at the realities. You know,
I agree. I don't think you should. I think too many people look at correlation in the way where they go, okay, well, you have to have all these uncorrelated assets, and then you have to identify correlations and so on. For me, I did that for a time and tried to figure it out at first, and then I was like, okay, well, this just leads to bad returns when you backtest it. So I think finding things, here's a good thing to just say: finding things that are uncorrelated for uncorrelated sake is a bad idea. That's probably the easiest way to say what I'm saying.
Yeah, I mean, I guess it's like there's a ton of opinions on that. Like, but yeah, I guess diversification is very closely related to correlation, right? Or lack thereof. And there's really multiple kinds of diversification if you think about it. So there's like diversification away from single stock, idiosyncratic, the old CAPM stuff, right? And that was kind of Bogle's contention. It's like, you should just buy the market, don't buy a single stock because you could blow up and people don't do very well at that. But then there's like Warren Buffett and Burry and Chase Coleman and guys that do. And some people might say, well, they're total outliers. Like, you give a million monkeys typewriters, eventually they're going to type Shakespeare, right? But I don't know. I tend to think like these guys that have been very successful, and there's more to it because, Buffett's early days were easier, but they concentrate in stocks. But then there's asset class diversification. So that's sort of modern portfolio theory. And that's, we're trying to achieve the highest return for risk, where risk is volatility. And I have all kinds of problems with that too. We could dig into at some point. I mean, you can have a portfolio that goes up 5%, down 5%, one that goes up 10 and flat, and those have the same volatility. So they have the same risk per modern portfolio theory. Now, MPT would pick the one that's up 10 flat, but there's something fundamentally wrong if like up 10 flat, up 5, down 5 have the same volatility or standard deviation, right? And then there's trend diversification, which I think is a totally different animal. So trend, to me, like, what is trend following? I think at the core, it's a bet on human nature going to extremes, and that something somewhere is going to go up or down a lot. And if you get into things that are going up or going down, and then you cut your losses quickly, and one of them is going to go and pay for everything else, whether it's up or down, right? So that diversification isn't like, let's do stocks and bonds together on the long side because they play nice, or they have historically, which they may not in the future. That's more like, the more markets I throw at my belief that something is going to be an outlier to pay for everything else, that's a different type of diversification. So it gets really complex, or at least there's a lot of layers to it, depending on how you look at it. But personally, I guess I don't love diversification. I don't love correlations as a measure. I like stop losses, because diversification to protect against losing money presupposes that the future is going to look like the past. I've never heard anybody say, well, these things were uncorrelated at difficult times historically, or they weren't, but I'm going to bet that they're going to be in the future. It's always based on historical data. So you're always making the assumption the future will look like the past and it'll protect you. And I personally don't buy into that, because the world can change. I mean, we looked at 2023 where stocks and bonds dropped together, 2022, sorry. So I like the stop loss, get out of the way. What can be better than that? But even with that, you still have like, well, the bank could fail, the government could fail. They have historically. So it depends on what level of risk you're trying to manage, how you view risk, different correlations, different whatever. And I guess for me, I try to simplify it. And if I'm trying to make larger returns, I want to be concentrated in a handful of stocks predominantly, as opposed to a leveraged trend system. But it looks like we're at the hour, man. So maybe we could
we'll wrap up. That. But I think maybe next week we can kind of chat more on that, because it's a deep conversation that actually is really important, that I think a lot of traders, when they're new to trading, just overlook completely. And there's different ways. I've even heard you mention, you kind of think of trend following as its own way of a single bet, in which we could talk about that a little bit more next week too.
Sure.
All right, guys. Thanks for joining us.